For the first time, the Indian rupee breached the psychological barrier of 77 against the dollar on Monday to close at a record low of 77.46, raising fears that India's inflation situation could worsen. Retail inflation in March neared the 7% mark, largely reflecting the impact of geopolitical spillovers, and a Reuters poll suggested that it has likely surged to an 18-month high of 7.5% in April. Widening trade and current account deficits, heavy foreign fund outflows, and a strengthening US dollar have pulled the currency down nearly 4% this year. The trade deficit surged over 30% year on year to $20 billion in April, mainly on the back of higher energy prices. India's current account deficit is expected to widen from 1.5% of GDP in FY22 to as much as 3% in FY23. Meanwhile, foreign investors have pulled out a whopping $19 billion from the Indian markets in this calendar year so far. This compares to net inflows of $7 billion in 2021, $14 billion in 2020, and $19 billion in 2019. The US dollar has been on a tear as investors piled on the safe haven currency, with the Federal Reserve seen as tightening monetary policy more than peers. Risk aversion in global market means funds are flowing to the US. The dollar index, which tracks the currency against a basket of major currencies, is up nearly 9% this year and hit its highest in 20 years. It is not just the rupee, but most currencies were sent tumbling because of the dollar upcycle. In fact, the Indian rupee has performed relatively better than some of its emerging market peers.
The rupee is not being singled out, in terms of weakness. We are seeing this across the board. So if you look at currencies like, say, the Chinese renminbi, or you look at Korean won, or you look at Japanese yen, they have actually weakened far more than what India has in the last, say, 3 to 4 months. These things tend to come in cycles. So it could be that the rupee plays a bit of catch up with them, but we are certainly not seeing rupee being an underperformer as far as the broader EM currencies are concerned. There was obviously the pressure from, global currencies, particularly the dollar has been strengthening. At the same time, we have seen the CNY, the renminbi weaken quite dramatically. So, it's sort of like across the board, we are seeing several Asian currencies weaken. And so the rupee is weakening along with it. The move in the rupee is not something that should worry us too much because it is not being isolated. Our sense is, though, that, given India's external foreign debt position is quite low compared to, say, some of its peers like Indonesia, we should again be not singled out as as a currency which will be punished or anything like that.
The biggest impact of a weakening rupee is on inflation, given India imports more than 80% of its crude oil, which is India's biggest import. Oil has been hovering around $100 a barrel for more than 2 months now, and a weaker rupee will add to inflationary pressures. India is also heavily dependent on other countries for fertilizers and edible oils. The country's fertilizer subsidy is already set to hit a record high of as much as 1.9 trillion rupees this fiscal, according to CRISIL. While a weak rupee makes imports costlier, it has some benefits too. In theory, it makes our exporters more competitive. But in a scenario of weak global demand and lingering volatility, exporters are not cheering the currency dip. Ajay Sahai, the Director General of the Federation of Indian Export Organizations, recently told Business Standard that India may not gain much if a competitor's currency is depreciating at a faster pace. Further, India's key export items such as gems and jewelry, petroleum products, organic chemicals and automobiles, and machinery items have a significantly high import content. With rising commodity prices due to supply shortages, the cost of production for exporters will go up, affecting their margins. Therefore, export sectors where the import intensity is high, such as electronics, may not see a gain. Services sectors like IT and labor-intensive export sectors like textiles will indeed benefit.
So the biggest impact of a weakening rupee obviously will, sort of be felt on the inflation side. While commodity prices are already pretty elevated, the impact through the currency channel is also going to be slightly negative, although the sensitivity of inflation to the currency has been declining over the years. The other impact that can be felt is, maybe perhaps through some improvement in export earnings, at least from a convertibility standpoint. But then this is going to be only a mitigating factor, not something that will get completely offset against, the downsides of inflation. Now, in terms of, where we are, relative to others, I think, the rupee has actually held up reasonably well against its peer currencies, both in the region and also across emerging markets. We are somewhere in the middle of the pack, and looks like we are weakening broadly in line with the global trends. Now, in terms of the defense of the rupee going forward, I think it does kind of appear that the RBI is smoothing the weakness out. But then I would say it would be ill-advised, to really try and defend any particular levels, given that this is a global move. We have enough foreign reserves and dollars committed in the forward book, to meet any contingencies. But my sense is that over the next few weeks, there is likely to be generally some pressure on the foreign exchange markets. Yeah. So in terms of the subsidy bill itself, there will be a marginal impact, but the bigger channel is still the prices themselves, right? So if you see some, say, correction in prices versus a weaker currency, I would say the price effect is going to dominate far more than the exchange rate effect.
India's foreign exchange reserves have fallen below $600 billion for the first time in a year as the RBI intervened in the forex market to defend the rupee. The reserves fell to $597.7 billion for the week ended April 29, down from the all-time high of $642 billion at the beginning of September last year. Most of this fall has come in the last 2 months. Rahul Bajoria says that over the next 3 to 6 months, rupee could weaken further beyond 78 level and go as low as 78.5 or even 79 levels. However, he says that in the second half of the fiscal year, with the RBI expected to play catch-up with the US Federal Reserve on the interest rate cycle, rupee may stabilize with marginal appreciating bias. Nevertheless, experts are of the view that India has enough firepower to stem any sharp slide in the local currency.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.